Hi, my name is Nathan Davis. I'd like to give you a mortgage market update for the month ending August 2015. So we've certainly seen a wild ride with the financial markets over the course of the last week or so. With that being said, mortgage rates have not really changed that much. We saw a little bit of a dip, but with the recovery in the stock market over the last few days, our rates have pretty much come back to where they were before the stock market took a dive. Right now, rates are trending between 3 7/8 and 4.125 on a 30-year fix, depending on whether you're looking at an FHA or conventional loan. Now, there's still a lot of things yet to happen. We don't know what the Federal Reserve is going to do with regards to short-term interest rates. The thought was before the end of the year they would certainly raise rates, but with some of the things we're seeing in the financial markets, that may not be the case. We also have varying opinions on the world economies. So as these things kind of play out, it's certainly going to give us some indication of which way rates are going to go, whether they're going to head up as we've expected or stay in these lower levels around 4%. So I'll certainly keep you posted as we see those changes take place. I did want to share with you some changes that have occurred with FHA loans as well as conventional loans over the course of the last week or so. Let's start with FHA. Beginning September 15th, there are some significant changes with FHA guidelines. In fact, what FHA did is they really rewrote the book, if you will. They rewrote their underwriting manual, consolidated many changes and rules that they've had for years into one new manual. Now, there are some changes that are going to affect buyers' ability to qualify going forward. Now, in this message, I have attached some of those changes so you can read them, but I'll highlight them very quickly that I think 4 significant ones to pay note of. Number 1, gift funds. We're going to have to do a more thorough job at documenting gift funds from a donor. That can be problematic because sometimes donors don't like to give bank statements or things like that because they're not party to the transaction and they don't think it's really our business. And where that's understandable, FHA has pretty well set a hard line on us needing to document that. Number 2, student loans. In the past, we've been able to exclude student loan payments when student loans are deferred. We can no longer do that. That'll definitely affect debt-to-income ratios on FHA buyers. Number 3, sourcing large deposits. Now FHA is saying we need to source deposits that are greater than 1% of the purchase price. So if you're dealing with a $200,000 purchase, any deposits that go into someone's account of $2,000 or more have to be sourced. Again, that can sometimes be problematic when people have cash on hand and things of that nature. The last thing is the timeline for starting a FHA loan with significant derogatory events. Now, in the past, we could start processing a loan while we were waiting for the waiting periods for, say, a bankruptcy discharge date, a foreclosure short sale, to finally reach the marks that they needed to be at. We can no longer do that. We now have to wait for those events to season before we can start an application. So for example, if someone has a bankruptcy discharge that we need to wait 2 years, we cannot start processing the loan while they're at 1 year and 10 months. We need to wait till it's a full 2 years. So those are just some of the key changes I noted. Again, I've attached some more information in an email sent to you with this video. Lastly, conventional lending. Fannie Mae rolled out some new guidance on qualifying self-employed borrowers, specifically how to calculate their income. Now, these changes don't occur till February, but they're encouraging lenders to start implementing some of these things over the course of the next few months because it may take a while to kind of catch on to how to do this. But in short, what they're now requiring is that we cannot just use the income as shown on an individual's K-1, which is kind of similar to a W-2 or a 1099 that a self-employed person uses to verify their taxable income with the IRS. We now have to verify the distributions taken from the company. So if someone is actually earning the income but not taking the distributions, Fannie Mae is saying, hey, you've got to stop and make sure if they're not taking the distributions that they have the ability to take the distributions. In other words, do they have the money sitting in their business bank account? If they don't, we cannot use that income. Now that can be very important with a lot of our self-employed borrowers because frankly, if I look back at many of the borrowers we have done loans for that were self-employed, they didn't take a lot of distributions. Now again, we'll have to dive in a little bit deeper, which is the key component with self-employed borrowers. So you want to pay close attention to that as you have your self-employed borrowers going forward, making sure that they're getting thoroughly pre-approved because just looking at one page on a tax return isn't going to do it anymore. So Coming up on my next video, I'm going to be talking about TRID and some of those changes that were going to be taking place here October 3rd. You've probably seen a lot of different webinars and conversation about it. The good news is I don't think you're going to see a big impact on our process, but there's going to be three components that I want to share with you that are going to be really valuable to make your transactions go smoothly. So I'll talk about that in my next video. Hopefully you've appreciated this update. Again, I'm Nathan Davis, 239-898-8841.